Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of understanding operating leverage, a key factor in business profitability. Impacts of operating leverage on business performance. Operating leverage significantly affects how businesses perform and their overall profitability. By understanding its consequences, you can make better strategic choices. Here, we explore the trade-off between profitability and risk, as well as how operational flexibility is influenced by operating leverage. Profitability and risk. Operating leverage creates a trade-off between profitability and risk. High operating leverage can lead to substantial profits during strong sales periods. However, it also poses significant risks during downturns. Let's break it down. Greater profit potential. When sales rise, businesses with high fixed costs experience bigger profit jumps. Since fixed costs stay the same, more income contributes to profits. A modest sales increase can lead to an outsized profit boost. Increased vulnerability. Conversely, if sales decline, these businesses can suffer heavy losses. The fixed costs remain high, leading to a bigger negative impact on profit margins. Recognizing this risk is crucial for financial planning and forecasting. Analogy of a roller coaster. Think of a roller coaster. High peaks, strong sales, can create thrilling moments, maximized profits, but the drops, sales declines, can be severe. This is the essence of high operating leverage. Risk management strategies. Businesses should adopt measures to mitigate risks. This could involve maintaining cash reserves, diversifying product lines, or adopting a more flexible cost structure to reduce fixed overheads. Balancing potential profits and risks related to operating leverage is essential for sustainable growth. Business leaders need to assess their risk tolerance carefully and prepare for various market conditions. Operational flexibility. Operating leverage also impacts operational flexibility. It shapes how businesses react to market changes and customer demands. Here are some points to consider. Fixed versus variable costs. High operating leverage typically means a business carries significant fixed costs. This often restricts operational flexibility. Rapid shifts in demand may make it tough to adjust operations without incurring additional fixed expenses. Adaptability. Businesses with low operating leverage enjoy greater adaptability. They can easily scale up or down based on market demands. This flexibility often leads to quicker decision-making and opportunities to seize emerging trends. Resource allocation. High fixed costs can lead to overcommitment in certain areas. If a business is tied to heavy investments in machinery or facilities, it may have less room to shift resources to new projects or innovations. Long-term planning. Companies with a rigid cost structure may struggle with long-term planning. The need for consistent revenue to cover fixed costs can lead to conservative approaches that stifle growth or innovation. In conclusion, being aware of how operating leverage affects both profitability and operational flexibility is key. It allows businesses to make better decisions, manage risks effectively, and stay adaptable in a changing environment. The interplay between these elements shapes a company's overall performance. Strategic implications of operating leverage. Understanding the strategic implications of operating leverage can significantly shape your business decisions. It informs how you approach investments and pricing and can guide your overall strategy. Investment decisions. Operating leverage plays a crucial role in shaping investment strategies. Businesses need to assess how fixed and variable costs will impact profitability when making major investments. Here's what to consider. Assess profitability. Before investing, evaluate how increased sales from new assets could boost profits. High operating leverage means that any rise in sales can lead to substantial profit growth. Risk assessment. High fixed costs can amplify risks. Ensure that you have a plan for downturns. Consider diversifying investments to share the risk across different areas or products. Long-term commitments. Investments in fixed assets, like machinery or buildings, solidify your cost structure. Ensure these assets align with long-term goals. Ask yourself, will this investment support sustained growth? Ownership versus leasing. Decide whether to buy or lease equipment. Owning may lead to higher fixed costs, while leasing offers flexibility, which is vital in uncertain markets. Capital allocation. Analyze how much capital to allocate to fixed versus variable cost structures. A balanced approach allows you to manage profits and risks effectively. These decisions should be backed by thorough analysis and forecasting. The goal is to ensure that spending aligns with your business environment and growth expectations. Pricing strategies. Operating leverage also has a significant influence on pricing strategies. Understanding its dynamics aids in setting prices that optimize profits while remaining competitive. Cost structure awareness. Know your fixed and variable costs. When prices are set above variable costs, each sale contributes to covering fixed costs and generating profit. Competitive pricing. High operating leverage means you can potentially lower prices to capture market share without sacrificing too much profit. Just be careful. Ensure that reductions won't put your fixed costs in jeopardy. Sales volume expectations. Anticipate how sales volume will affect pricing. If you expect to sell more, you might price products lower to maximize market penetration. Value proposition. Clearly communicate the value your product brings to customers. If they see the benefits, they might be willing to pay a premium, even in a high leverage environment. Profit margin management. Keep a close eye on profit margins as sales increase. Make adjustments if fixed costs become too burdensome. This may involve reassessing pricing as sales volumes fluctuate. Incorporating these strategies helps you manage the relationship between operating leverage and pricing effectively. It empowers you to set prices that balance customer attraction with profitability. Case studies in operating leverage. Operating leverage isn't just a theory, it has real-world implications. By examining case studies, we can see how businesses navigate the highs and lows of fixed and variable costs. This section highlights both success stories and warnings from companies that faced challenges due to operating leverage. Successful companies. Many companies have thrived by effectively managing their operating leverage. Here are a few notable examples. Starbucks. This coffee giant maintains a strong brand and significant fixed costs due to its store locations and employee salaries. However, their high sales volume allows fixed costs to distribute over numerous transactions, leading to impressive profit margins during growth periods. Tesla. Tesla's substantial investments in machinery and facilities create high fixed costs. Still, as production grows, the sales revenue from electric vehicles significantly outweighs these costs. Their innovative approach and growing market demand amplify profitability despite high initial costs. Netflix. With significant spending on original content, Netflix faces high fixed costs. As their subscriber base expands, profits skyrocket. Their business model capitalizes on fixed costs becoming less significant per customer, allowing for sustained growth in earnings. These companies demonstrate that high operating leverage can drive success when sales are strong. Their ability to scale and meet demand plays a crucial role in maintaining profitability. Failures due to high operating leverage. While some companies succeed, others have struggled under the weight of high operating leverage. Here are important cases to consider. J.C. Penney. After years of high fixed costs from store leases and renovations, J.C. Penney faced severe declines in sales. The company couldn't reduce its overhead quickly enough, leading to significant losses and eventual bankruptcy. Their reliance on fixed costs without adjusting for changing consumer behavior proved detrimental. General Motors. During the 2008 financial crisis, General Motors suffered immensely due to high fixed costs. As sales plummeted, the burdens of manufacturing and operational costs became overwhelming. GM's inability to adapt to downturns led to bankruptcy and a major government bailout. Eastman Kodak. Kodak had high fixed costs tied to its film products. When digital photography gained popularity, Kodak struggled to pivot. Their large investments became unsustainable, resulting in a steep decline in sales and eventual bankruptcy. These cautionary tales highlight the risks of maintaining high operating leverage without considering market fluctuations. Companies must stay agile and ready to reassess their cost structures when faced with changing conditions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.